Well, J Powell stands up. No more Mr. Nice Guy, he screams at markets, sending markets into a tailspin. We've got the VIX above 30%. We've got the dollar pushing top of its range. Gold prices get slammed as real rates move progressively higher. We discuss all these factors and more as we go into the trade-off. Well, hi, my name's Chris Weston, Head of Research here at Pepperstone. I'm joined in a minute by Blake Morrow from Forex Analytics. We're going to be analysing, unpacking, navigating all the landmine setups, as we always do, as we go into the trade-off. And we're going to be looking at all the madness that's going on in the financial market. So, of course, if you like what you hear, do hit the like button, smash the like button, leave a review, leave a comment, and we'll get back to you those when we can as well. But it's just such a crazy time in markets, so much going on. And so I'm going to bring Blake into the programme. And just, before we go into, Topical Thunder and actually dissect some of the key macro themes, I mean, we're talking about high volatility in these markets, Blake. You're a veteran. I'm a veteran, perhaps not as veteraned as you are. But how are you adapting here? What sort of knowledge can you depart on viewers to trade and adapt to this high volatility environment across asset class at the moment?
Gosh, that's a great question. And nice to be back here, Chris, and good to see you and the team there at Pepperstone. I'll tell you, volatility is obviously on the rise, and it really is. It took me for a ride actually early on in the week. Yeah. And when you figure it out that volatility is the bands are getting a little wider, is when you step in front of the market. As traders, we always look for a reversion back to the mean. You know, we can say, all right, well, the trends. Like, for example, the stocks are so bearish, I'm going to get short, and then they've gone down what you think might be far enough, and then you stick in a bid, and then you get rolled over. That happened to me this week. I actually thought on Monday, hey, we're a little oversold, put in a bid, got long. I had to step away from my desk, got stopped out as I was away from my desk 30 minutes later, and I was like, wow, that was quick. And when things like that happen to me, I know that volatility is on the rise, and I need to really start being very careful, because usually I can navigate as a veteran in the markets. I can navigate through the normal volatility, and when things look a little overbought or oversold, I start to look for fades, and I can play that pretty, again, for somebody who's been doing this for a while, I can navigate through those situations pretty easily. But when I get stopped out, that usually has told me that volatility is really on the rise, and I need to start being very careful about going about my business in the markets. Yeah,
good wisdom. I mean, for me, when you've got volatility this high, certainly in equity markets, we've got it in fixed income and other factors. Position sizing is absolutely your first consideration. You've got to look at that position sizing. You've got to understand your risk, and don't believe you're better than the market, because you'll get cut up every day of the week. So high volatility, you need to adapt. And let's talk about what's caused the volatility. So let's go into the key themes, and I really want to discuss these for you because they're front and centre at the moment. Let's go into Topical Thunder and dissect. Well, Blake, the FOMC meeting, the statement didn't give us anything new, to be honest. But then Jerome Powell stepped up, as I said in the earlier section there. He stood up and said, "No more Mr. Nice Guy." Now, I'm concerned. A lot of people are concerned that the Fed are dramatically behind the curve here, with inflation at 7%, full employment at 3.9%, and I think he sort of showed an increased amount of caution in his rhetoric about inflation going higher and staying high for a long period of time. He's given us a lot of what we already knew, but he's reinforced so many of these messages, and the market's taken this as very hawkish. We've seen significant rise in nominal and real rates. The dollar's gone for it. Equities came off on the back of what he said there. But how much are you reading? What did you take out from the Fed meeting yourself, and what does it mean for your market views?
Well, that you made all great points, and you're right. Fed Chairman Powell, he didn't really. A lot of people thought he might backtrack a little bit, or maybe I want to say backpedal maybe is a better way to phrase it. Backpedal a little bit because of the volatility we see in the markets. Obviously, that didn't happen. But what that really tells me, Chris, is now over the next two months, we really, really need to focus on the data.
Yep.
And inflation data is obviously going to be front and center. But boy, I'll tell you what, when you start thinking about the number of rate hikes that we might have this year, and then you start thinking about, well, instead of a quarter basis point hike in March, could we really get a half a basis point? And that's when now expectations will really start shifting pretty wildly. Based on economic data that comes out. What are your thoughts?
I want to take on that point because you're right. We've seen a tightening financial conditions. Credit spreads have started widening. The VIX is something that's something they don't really want to see. But the VIX is at 30%, and equity markets have obviously pulled back significantly. So. The fact that when he was asked about financial conditions, he didn't really give any kind of definition, and he didn't really give any kind of concern around them. The market felt validated in this response. We've priced in rate hikes aggressively. We've sold risk. We've sold. We've pushed out wider credit spreads on high yield, and the Fed chair isn't concerned. He wants tighter financial conditions because that is effectively what they're trying to achieve with monetary policy. So it was game on in that regard, and I think the market is ready to go. But look. I think we've got about 20% chance for that May meeting now of a 50 basis point hike. A 50 basis point in my height is an admittance that they've messed up, that they are behind the curve, and there's a policy mistake. They've allowed inflation to get too hot for too long, and now they need to front load and get aggressive with rate hikes. But there's also a lot about balance sheet reduction, and we're going to hear a ton about that in various Fed speakers going forward. So we're now left with a situation where the market's pricing 4.5 rate hikes. There's almost a 50 basis point hike price for March, and we're talking about balance sheet. It's easy to see why gold got slammed. We could talk about that. Why equities got slammed. No more Mr. Nice Guy. The Fed are behind the curve. He wants to step back in front of it and regain some composure there.
I think your feelings are a little transitory, Chris. Let's just say
very
that.
Very good. Non-transitory. I think that's pretty clear.
Well, let's talk about some of the repercussions of what happened today. Let's talk a little bit about the dollar. I mean, the dollar index. I was telling our traders today earlier this session, the U.S. session, for you yesterday. I was telling our traders, look, the trade is to be long dollars, and it's the boring trade, but it's a trade that's probably going to work as the Fed's not going to veer off schedule, and they're going to just maintain. The Fed's got to retain some credibility here. Here we go. Here we have the dollar index, and the dollar index is approaching that 96.90, trend high resistance. And we're going up there in a pretty rapid rate. We've got the euro back below 113. Actually, it's below 112.70. We made lower lows now. So it looks like the dollar's ready to rip higher. I'm wondering, are we going to hit new trend highs? And how high will the dollar go? I had originally always believed, Chris, that the dollar is going to see 100. I don't think in this leg higher it's going to see 100, but I do think that we could make it closer to 98. Some of the levels that we saw back in, I would say May of 2020, roughly that time frame. Yep. I think those are the levels that we're going to be seeing the dollar rally to, which could put the euro, maybe around 111 or so. But what are your thoughts on the dollar here? Because I sure would hate to fade it, but it does look strong. And, do you think we're going higher?
Well, I think, if the Moreau family are thinking about going on holiday in Europe in any time soon, I think you're going to get more money for more purchasing power fairly soon. I do sit in the bullish dollar camp, and I think long dollar Swedish krona makes sense right now. Short euro dollar makes sense right now. We've seen a trend break. It's going to be my play of the day. We're going to talk about that in a second. I mean, have a look at the headlines we're seeing this morning. The European Central Bank are talking about looking at European lenders with Russian exposure on their balance sheet. Potential sanctions coming through there that could hit the European banking sector is breaking headlines. That's going to be euro negative in itself. The concern I have about long dollars is the yield curve, though, Blake. I mean, 5s 30s are breaking down with 47 basis points. We've got 2s 10s at 70 basis points, a flatter curve. Going towards an eyeing inversion. The Fed do not want to do that. That's where rate hikes get priced out. So you've got to keep an eye on the curve. That's a dollar negative, but at the same time, everything else now in terms of policy divergence is favouring the dollar again. The technicals are favouring the dollar. You've got a very, very hawkish Fed who is saying we are genuinely concerned about inflation. So I don't want to agree with you here because agreement is never good. But I find it hard not to be a dollar bull right now. I've been fading that, and I like it. I like the dollar bull.
Well, I'm tending to agree with you, and you're right. We shouldn't agree, but maybe we'll agree to agree, or disagree to maybe we shouldn't agree.
Yeah, I think you made a really good point. Now, watch the data. Watch the upcoming upcoming data that's coming with the ISM manufacturing numbers, the next payrolls number. We're looking at wage pressures again, all these kind of factors, and then of course the next CPI print, which comes out sort of I think around the 11th of February. If that again comes out above 7%, we expect it to come out 7.2. Yeah, the dollar just keeps going, and that March number is a lock on. And the question will become whether we get 50 basis points and how much colour and how much context do we get about balance sheet reduction playing through. All of those are dollar positive there as well. So just going through in terms of sentiment, one of the things we've been seeing is this massive drawdown in equities. We talk about in those setups, but obviously a lot have been down to flow. The Nasdaq's been slammed. You've seen global equity markets being slammed. You've certainly seen some other risk assets getting whacked as well. A lot of that, as I say, is down flow. You've seen liquidations playing through. You've seen vol targeting funds who've seen high volatility. They've had to raise cash levels, reduce exposure in the market because of that. You've got hedging coming through from options market makers, and effectively they've been selling puts in Nasdaq and S&P, and that's caused the big move down. But we've got so oversold. Market internals are horrific at the moment in terms of how much pessimism's being priced in, and we're getting people trying to say that this is a really strong buying opportunity. JP Morgan is saying that, Citigroup, people are saying there's so much pessimism in now, there's oversold, we've got earnings coming up. I'll ask you the question now, with the Fed coming out much more hawkish than what the market was expecting, amongst this backdrop of very oversold conditions, is this the time to buy risk assets such as equities here?
Yeah, I don't know, Chris. I'm sitting here looking, I'm thinking the same thing. It's like once sentiment gets so lopsided, you get to a point where you're like, okay, now I've got to take the other side of that trade. I'm not sure we're quite there yet, but I will say that, we've come off pretty hard. Just from a percentage basis, just from the highs, from where we're currently at. If you take the S&P, we're only down 10% off the highs. It's not, it's not catastrophic yet at this point, but I do think we are getting into levels where I do look at a lot of sentiment indicators. Like one of the things that we tend to subscribe to is the daily sentiment index. Yep. We call it the DSI. That's getting into kind of balmy territory. We're getting into the 20s. You start getting me into the single digits, which might be in the next week or two at this rate. Then I start to, maybe flip, counter trend, tactical bullish, if you will. But I do think sentiment is starting to get extreme. But we're also, the day of or after the FOMC meeting, we might have a couple of days of follow through, and especially if we see the rest of this week, how other asset classes tend to perform, this could feed on itself, and, stops are a real thing. And one thing I do have to mention about sentiment before I turn it back over to you is sentiment is a mother to turn around. Once it turns and that Pavlovian instinct of traders and investors shift, that's something that the Fed has to wrangle with, because once that sentiment shifts, it's hard to turn around. You use that word Pavlovian again. I have no idea what it means, but it sounds great. And you've got a situation. No, I agree. This sentiment needs. The people have got a shopping list. They want to buy IBM. They want to buy Microsoft. They want to buy Nvidia. But sentiment needs to turn around. You need an excuse to start and buy it. And a lot of that will be down to flow. So I think we are grossly oversold, but we could be down another 3-5% in this market. The fact is, people are eyeing the Fed put. People are looking for the Fed put. Powell didn't give you anything yesterday in that overnight speech. He didn't give you any reason to believe they've got the markets back here. And that says to me that rallies are to be sold. These are bear market rallies taking place at the moment. Until we get that Fed getting more worried about credit, about what's going on equities, I'm a seller of rallies in this market at the moment. So I guess we better start looking at like when the list of board governors are out speaking and see when Powell's got his little army out there talking trash and seeing what happens there. All right, well, let's talk about crypto. Talk about sentiment. One of the things that I've really I've really talked a lot about this over the course of the last year, even before we started the trade-off series, this wonderful show that you guys put on here at Pepperstone. I've talked about crypto being like the ultimate risk asset. It is. It just really is. It's like the most speculative asset class out there right now. Even and we could argue, we could talk about, how all the cryptos have been, kind of interweaved, excuse me, it's late in the day for me, interwoven into, some of the fabric of the financial markets and whatnot. But ultimately the crypto space as a whole is a real speculative space to be in. And, when you're talking about everybody's targeting Bitcoin now and to 20,000, I think 20,000 is the 2017 previous highs. That was the big breakout point. Everybody's looking for it. Well, Chris, if everybody's looking for it, are we going to even get there? What are your thoughts? I mean, you asked me 3 or 4 years ago, I would have said technically, yeah, I think you step in front of that. But either we're going to overshoot it or we're going to stop really, shy of it, maybe 28, 20, 25,000, or we're going to see 10,000. Yeah. I don't know if 20,000 is going to, stop the trend should we get there. What are your thoughts on crypto and how it's acting?
Yeah, I mean, I think people are saying, is it an inflation hedge? I do think it's an inflation hedge, just not against realised inflation. It's against expected inflation. There's been a strong correlation with five-year forward rates, so expected inflation, and that's been coming down. There's been liquidity concerns coming through the market. People are concerned about a balance sheet reduction, so the liquidity beneficiaries have been under pressure. The Fed are talking about their balance sheet reduction being faster and more aggressive. Again, this is something the crypto market's looking at. So I do think it's an inflation hedge, just inflation expectations are coming down and then crypto is coming down with it. So it's just coming down at a faster rate than other markets. So it's a high beta market again. Look, I sell rallies in crypto. I think all of that what I've been talking about equities remains. We may consolidate for a little bit at the moment. The market's had a big adjustment, but any kind of pop in this, any decent pop in Bitcoin or Ethereum, and I'll be looking at levels to sell into at the moment, given the macro dynamics that are playing through at the moment. So I remain a seller. Don't fight the Fed. If you're not fighting the Fed, you're a seller of rallies in these risk markets, I believe. What do you think?
Well, let's talk about like the little mini Chris's of the world and your family. I mean, you're going to be putting some Bitcoin or Ethereum or Solana aside for some of the little ones.
Well, I've got some NVIDIA waiting to go in that shopping list. I've got some Microsoft waiting to go. Great earnings from them the other day. Market, initially sold it down 6%. They've got a few issues with the cloud, but it's still growing at 46%. The market's looking for 48. But it just shows you right there, when you looked at Microsoft earnings as a proxy of what's going on, you can come out of fantastic earnings. If you're not blowing the light out, your market just looking for a reason to sell in this situation. So, I think there's a shopping list that people are looking at and going, give me those companies with great earnings, great balance sheets, all quality earnings, and a sort of monopolistic qualities. And if you get down to levels, we're filling our boots, and those are the sort of companies I'll be putting in my son's shopping list.
I didn't hear any cryptos then. Okay, all right. Well,
yeah. Well, okay, cool. Now, we've just talked about some of the thematics that are going through. Let's go into the setup, have a look at them in a bit more depth, and look at the rhyme and reason. Let's have a look at the flow and capital we're seeing there. Well, first up, Blake, I want to bring up gold. A great chart. It's one that I talked about last week. We pushed through that sort of 1830 high. It turns out it's obviously a bit of a failed breakout, but what we're looking at is that multi-year trend line that we've been seeing coming from 2020, and we've tested that at 1850, and we've rejected that. Now we're just testing that rising trend at the moment. So we're kind of, what are we doing? My thesis last week and in prior videos was that gold is a hedge against a policy mistake from the Federal Reserve. But that policy mistake is one where they raise rates too quickly. The market gets worried that it's going to impact economics. The market then forces the Fed to price out rate hikes. And then gold is a hedge against that policy mistake. What we're seeing now is, as you can see there, as we traded that to the downtrend, is gold is a hedge against a policy mistake. The policy mistake is very different than what we've heard. The policy mistake, which everyone is looking at, is this idea that the Fed have allowed inflation to run too hot for too long, and now they're going to have to slam on the brakes far, far quicker. And the market is not pricing out rate hikes, they're actually pricing in rate hikes. So gold didn't like that because real rates have gone up. So we're at this kind of make or break situation. I think tactically, until we can see a situation where the market goes that the Fed are going to have to price out rate hikes, which is not happening, then gold is probably got some downside risks, and it sort of commingles with my stronger dollar position there. What do you think?
I'm watching the 200-day moving average, which comes in right above 1800. And frankly, yeah, we break through that, and you have to imagine gold's traded on both sides of the 200-day moving average quite a bit. I'm not going to look at gold and say, oh, we're heading back down to 1680.
No, absolutely.
But I do think that I think 1750, that's a doable level. 1760, 1750,
yeah.
that horizontal, some of those horizontal lows back in, I guess it'd be like September timeframe. I think that's doable. So if you're long gold and you can take that kind of a hit, then I think that's
correct.
What you could expect, right?
I think so, and yeah, I mean, it's this question of why you're in the position in the first place and your objectives. But I think if we get a break and a closing break of that uptrend that you're seeing there, then obviously the downside target, which seems too obvious, is 1760. But I think given that I expect a stronger dollar and real rates of where they are, I think it suggests that 1760 could be the level that we're going to see in the short term. Something that we can revisit next week.
Well, what I wanted to look at actually is I wanted to look at the Nikkei, and the Nikkei. Every time I think of the Nikkei, I think about that song like I'm turning Japanese, but it's by the Vapors. Just so you know, I'm half Chinese and I'm kind of turning Japanese on the Nikkei here.
Right.
And but the thing about the Nikkei is we've been in a really, really tight trading range for quite some time, since December of 2020, and you can see that multiple times that we've hit that really key support. We're sitting on it right now. And, when you're talking about extreme sentiment, one of the indexes here that could really get hit is, the Nikkei. And we get much below, like, let's call it 26.6, 26.5, somewhere around there. Typically I would look for a range extension, which would take us all the way back down to like 23,000. But you'll notice if you look to the left and to the far left of that chart, you'll notice the highs back in September of 2018. I think that's a doable target. And that's when you start getting down there, sentiment gets super extreme, where you get everybody's a bear. Everybody thinks that the world's coming to an end and the bottom's going to fall out. That's actually 161% extension of the last move. It's basically the range, 161% extension. That comes in around 24, 25, 24.4, 24.5. Somewhere around there, I think that's going to be a level that could be targeted to the downside. But what do you think of the setup here, Chris? Yeah,
it's like the Russell, isn't it? We saw that break through the range, and we traded down to the targets we looked last week. Again, this needs to be defended now, because if we get that break of 26,900, which is the low range there on a closing basis, we'll watch to see how that goes. The momentum guys are just going to go out and look to go short on this market. And they'll add to length, like pyramiding, and effectively if price continues to fall in short positions. And maybe we do get down to the 23,000 level, but I think that range break on what we saw Russell can be a great case study for this, because if this breaks, I think this goes down, and I think short positions will be warranted. Obviously, we'll be watching behaviour. And we'll be watching those flows that come through every week. But I think that range is really key. If you get such a range like this and it breaks, it's very, very powerful stuff, Blake. And, you've got to respect that, go along for the ride, I think, in that situation there as well. I want to bring that in. If we're staying on the index side of things, because we've seen really good volume playing through in the global indices this week, because we've got the Nikkei, the Nasdaq trading in a high-low range on average this week over the last 5 days of 3.6%. And that's punchy. People like range expansion. You like to scalp in and out of that range, those daily bars, whether you're trading on 15, 30-minute charts or taking a more of a sort of a swing position and taking that longer-term time frame. You can see that this is just been awful, really. Since those highs that we saw around 16,000, it's making lower lows, it's making higher highs. We've got to a situation in the session that we've just had where the market had a higher low and it tried to break out. It got up to the 38.2% retracement. The sellers have kicked in literally at the level. It's still holding the 5 and 9 day exponential moving average, which are moving perfectly lower. It sort of feeds into my idea at the moment now that rallies are to be sold in strength, and you continue to trade that within this bear market. We can look at various oscillators and say that the market's grossly oversold. Yes, but for me, until we can close above those short-term moving averages and people are selling into that, the trend remains lower. And I think bear market rallies are here. What do you think?
I think you have to sell rallies as long as rates continue to go higher. Some of these high beta names are going to come under pressure. The question is, how far are we going to travel lower? And I think if you continue to look left in your chart, which is not pictured on the screen right now, we might see those levels that we haven't seen since early 2021, which would be roughly around the 12,300, 12,700 levels, in the Nasdaq 100. I think those are levels that we might be seeing, on if you're selling rallies, but I don't know what I see here, Chris.
I'll tell you what I see, Blake. I reckon in 3 days' time, 4 days' time, what you're going to see now is you're going to see a triangle there. You're going to see the market consolidate. It's going to make lower highs and higher lows, and it's going to have this kind of consolidation. And then that's when we'll probably see it break out. But it wouldn't surprise me at all if we were to see, some sort of triangle pattern playing through, consolidation within this market before we get a new direction playing through. So I wouldn't be surprised if I saw that on the daily.
Well, let's see if we can get some consolidation here, because I'll tell you what, anybody who's bullish the Nasdaq definitely needs some consolidation.
Yeah, for sure. It's been tough.
That's what they're praying for. All right, let's move over to the dollar Canadian. You guys might have remembered this from last week. I was long the dollar Canadian going into last week. It played out perfectly, and then the question is, do I really want to dip my foot back into the well? And I hate doing that, Chris. I really do. But this setup is actually kind of juicy to me, because we held the 200-day moving average, the trend line that we talked about. It was a 50% retracement last week. We discussed all that. It rallied pretty sharply from 125. Here we are, about 120, 130 pips higher than where were we at this time last week. And if you're asking me, would I buy it again? The answer to that question is yeah. And the reason why is because crude oil has been absolutely bonkers. But we've got, Russia, Ukraine, France, Germany going to have, they've all agreed to have some talks in a couple of weeks. That envoy is going to bring some stability and maybe even a pullback to crude oil. That could allow for the dollar Canadian to break back above 127. We break above 127, I think we're going to travel back up towards 129. What are your thoughts here?
It's difficult because the Bank of Canada came out and left rates on hold. 75% probability was priced into the market, but they're going to go and hike on the 2nd of March. That's when the next meeting is. I mean, the market's saying that's pretty much a lock on. They haven't priced in any chance of a 50, but it's nearly 100% that we get that. Given what we heard from Macklin basically coming out and saying that all this economic slack has come out of the market. The output gap has really closed up quite sharply. They're going to raise rates in March, and the market's looking for over 5 rate hikes this year. So they're going to be one of the most aggressive central banks out there. But they did disappoint the market, and I think that's why we've seen dollar CAD moving up and breaking out of that downtrend, and that trend and the flow of capital still needs to be respected. So I remain a dollar bull. The question is, how do you play it? I've got a preference to do it against the euro and the the Swedish krona, and maybe the yen, but certainly the CAD still has a lot of appetizing and a lot of benefits to it that compel me. The technicals suggest that this can go higher, be buying pullbacks in this market at the moment. But fundamentally, I'd probably be looking elsewhere other than the CAD for my sort of funding leg relative to the dollar.
Fair enough.
There you go. Well, it's time. It's time this week. Last week I want to talk about. I came out of the exotic side of things, lean hogs, and that market's done quite nice. It's about 7% in that trade. Interested to hear some of your thoughts for this week. Let's go into play of the day. Yeah, Blake, I want to bring up the euro dollar chart there because, we've got my play of the day. I talked about it, throughout the show numerous times. We can see that the euro dollar is probably trading a little bit lower than that at the moment. We've broken out. We had this fake out there. We saw the downtrend coming through, coming back from May. We had the failed breakout there. Market took lower. Now it looks like we're starting to trend. We've got it priced below the short-term moving averages. The rate of change has been moving to the downside. We've broken and closed through the rising uptrend. The fundamentals obviously justify this dollar position. People are looking to sell sell the euro, the Swedish krona now. We've got all those issues that are happening in the Ukraine with European lenders. I like this one lower. I think we go to test those 112 levels. If we break that, I'll be adding to shorts, and I think we go down to 111, perhaps even 110. Yeah, unfortunately, a week is a long time between drinks when we talk about an update. This one next week, especially in the FX markets. So this may change, but I think right now, I think the probability is that we see lower levels in euro dollar. So that would be my play of the day there.
All right. Well, I'm going to say, Chris, great job on your lean hogs last week. One of the traders in my community, Leon, I'm going to give a shout out to him. He really liked your lean hogs play last week. So kudos to you.
Thanks, man.
All right. So, and as far as the euro goes, I might meet you down at 111 if we see it. Yep. All right. My play of the day actually happens to be Ethereum. I think Ethereum is one of those assets. We talked a lot about cryptos. One of the chart patterns that I don't think a lot of people are paying attention to is this slightly ascending channel. And that means that low that we put in this last week at like 2150, I think that place is now very critical support. And if that level breaks, we're going to see a lot lower levels in crypto. I think we could trade all the way down to like 1,000 in Ethereum. I mean, I know you're probably going, wow, that, it's pretty far away.
Seems punchy today. I've got 1750 as my case, but keep going.
Yeah, but we can still, I'm just saying could be some downside. I think the bottom breakdown point is set. And also to the upside, hey, we get above 2,800. I think you play it as a breakout to the upside. So I think the breakout points are set for Ethereum, and that's my setup of the day.
Great stuff. Well, nice to have your views there, Blake. Well, it's been an interesting week. We've just seen the Fed coming out. The market was looking for some pushback, this idea that they were going to welcome or sort of push back on the tightening of financial conditions. It wasn't to be. No more Mr. Nice Guy from Jerome Powell. He wants to fight inflation. If that means deflating asset prices further, so be it. And that's why Blake and I seemingly, have this kind of consensus view that we may see some consolidation, but perhaps, there's further downside in these risk assets. The dollar continues to be one that we both like at the moment, and potentially going to see some upside there. For me, we're looking at gold and potentially looking for some downside in that situation. Blake likes dollar CAD long. I'm on the opposite side in terms of looking at euro dollar shorts. Very interesting week ahead. Hopefully that volatility continues. But obviously, just make sure that you're just safe in that markets and you're adjusting your position sizing for that movement and the risk as well. So see you next week from the team at Pepperstone. Catch you guys next week.